Hey! Hi guys, and welcome to Macro Markets. This is Marcel Pechman, analyst and writer at Cointelegraph. Today is Friday, April 21st, and we'll be discussing the impacts of the macroeconomic news and events on the crypto space. We'll start today's show by discussing the mutual funds industry, which is basically the investment vehicles offered by professional investment firms. Among those well-known investment firms are BlackRock, Fidelity, Vanguard, JP Morgan, and many others. So you gotta question yourself, how relevant are those guys? What is the size of their investments? What are the typical allocation of them? So to answer your first question, the top 15 fund managers handle over $54 trillion, which is enough to acquire the entire S&P 500 index. I mean, every share of every one of the 500 largest companies in the US, plus all the gold ever extracted in the world, and the entire supply of global banknotes of every country, banknotes and coins. Sure, there's $250 trillion of bonds, means debt instruments issued by governments and companies, which certainly represents the biggest chunk of the mutual fund's $120 trillion portfolio. But there's a question there. What happens when the interest rates stay below inflation for a long time? For instance, Unilever 3-year bond currently pays a yield of 4.4%, while the US expected inflation for the next 12 months is 4.7%. So for the next 12 months, this Unilever bond investor is getting a negative 0.3 return per year if you deduct inflations. Those investors have been taking a loss because they're not comfortable on taking additional risks. So what I'm saying is that over half of the $120 trillion portfolio of the mutual fund industry is on very safe investments such as bonds. But if the inflation remains high, it's terrible news for them because most of those bonds will get yields, if you adjust for inflation, negative. So they're losing purchasing power of their investments year over year. Of course, if you think a big recession is going to happen or a big shift in the macroeconomic scenario, and you're okay, I'm going to lose my purchasing power in 0.5%, but if I leave money at a bank or opt for another investment, the loss could be much higher. So I rather lose 0.3 or 0.5 or 1% per year on fixed income. Except that's not sustainable for a long period. Moreover, if the inflation accelerates, the Federal Reserve has little or no room to further increase the interest rates, because that hurts the economy, that aggravates the recession, and the banking system is no longer in the same place it used to be. So there's only so much loss that those fixed income traders and investments can take. It can happen for a year, 2 years, 3 years, if they're waiting for a big recession or a big shift on the macroeconomic environment, but cannot go past than that. It's not sustainable to be losing 5-10% of your purchasing power after 3 years. They're probably going to shift to other investments. Also, hidden on this $120 trillion managed by the mutual funds industry is the passive funds, because not every fund manager has total freedom to choose what assets they're going to buy or sell every month or week. Those passive funds either track a single asset like the gold ETF or a portfolio. There's the MSCI index of Latin emergency markets and currencies. There's the Bloomberg Commodities Index. So those funds will track the index, so the fund manager doesn't have an actual voice in saying whether or not it should invest on an asset or how much it should allocate to each asset. According to Bloomberg, 30% of the US mutual fund industry follow some form of passive investment strategy. So Bitcoin's appeal to institutional investors might come on unexpected ways. For instance, the Bloomberg Commodities Index is currently represented by energy, grains, industrial metals, precious metals, soft commodities, and livestock. Will they ever include crypto? We don't know. But if that changes and eventually includes some of the cryptos, those fund managers will likely be forced to include those assets. Could Bitcoin ever enter the FX, Global Foreign Exchange Currencies Index, given it's the official currency of El Salvador? Well, the odds seem very slim at the moment. But if the adoption increases, who knows, perhaps it could become feasible. Bitcoin could act as a currency as the US dollar or euro, so it could be considered on FX indexes. So the one take I want you guys to have is the mutual funds control $120 trillion, and there ain't that many liquid assets available for them. On to the next topic. This time I'll take a request from a viewer from our last episode on YouTube. The author's name is Film City, and he questions how the unemployment rate affects crypto prices. That's a good question, Film City, because in theory, an overheated job market should translate to positive momentum for cryptos. If no one is fearing losing their job, becoming unemployment, why not take an additional mortgage? Or why not invest in something that's deemed extra risky but potentially rewarding? So if the families and persons are not fearing of losing jobs, because even if they lose their current job, it's easy to get another one, this creates a positive scenario for risk investments in theory. However, that has been far from the truth, considering the US current unemployment rate has been at the lowest levels in 40 years. The reason? Inflation. People making minimum wage are being forced to take extra jobs. And even the middle class, where a single person in that house used to work, now everyone has been forced to work to get a job to sustain their previous economic level. So not necessarily low unemployment rate means a positive, a bullish scenario for cryptocurrencies. On the other hand, if the unemployment increases, especially if it breaks above 10%, it will certainly bring a negative pressure for cryptocurrencies. It doesn't matter how much you love NFTs, you idolize your founder or project, if you're out of the job, odds are you want cash at the bank as your first priority because you have bills to pay. So, to answer Film City's question, it all depends on how much spare money the population has at the end of every month. Taking multiple jobs just to cover the bills won't help risk assets. On our third and final topic, we'll debate the US Debit Credit Default Swaps, CDS. CDS works as an insurance. You get paid if the debt issuer fails to honor their payment calendars. Believe it or not, there's a market for the US government, the Treasury's CDS. Although most time in history, such risk has been negligent. There's a cool chart from Hedgeye on Twitter showing how the US government CDS has recently reached its highest level in 11 years. So notice how the CDS rallies, especially from January 23 to April 23 up to 49, which has been the highest level since January 12. so 11 years ago. So Hedgeye says probably nothing. US sovereign CDS makes cycle highs today of 49. That was on April 19. Does that mean that the US dollar is dead? Not so fast, cowboy. It all depends on how the US stands against other governments, other currencies. Judging by the DXY index, which measures the US dollars against a basket of foreign currencies, there's no reason for panic. So the higher the index means the stronger the dollar against the global currencies, euro, yen, and other currencies. So the current level of 101 is not so bad. If you compare to the 2008 crisis, where it went to 72, the dollar is in a strong position right now. So saying that the US CDS rate reached its highest level in 11 years, it means nothing if the other countries are doing worse. Sure, there's a big question here. Well, but the US dollar reached 114 against other currencies in September 2022, and it devalued over the past 6 months. So yes, over the past 6 months, we had a US banking crisis, but also impacted Europe, with UBS and CS. So initially, the contagion risk was higher in the US, and now people seem to understand that the risk is global. But if you look at the broader time frame, the 101 index is not so bad for the US dollar. Some say Bitcoin is the best insurance against an eventual US dollar default. But the odds of such event, according to the CDS indicator, are slim to none. Remember, they can print infinite amount of US dollars. And that's not Marcel's opinion. That's one of the Fed chairman, one of the Fed presidents, Bullard, if I'm not mistaken, that said they have infinite amount of money that can be printed. So why would they default on their own debt? My suggestion, don't blindly follow any pundits or analysts. Make sure to create a solid investment portfolio based on your own needs. Well, that's it for today, guys. Remember to like and subscribe the new Cointelegraph Markets and Research YouTube channel. See you next week.